What's up, everyone? It's Professor Rako here. Today we're continuing on with our lease chapter. This is our sixth video that we're working through together, and this one is when we're adding in a guaranteed residual value on the lessee side. Okay, so once again, hard thing about this chapter: lessee, lessor, finance lease, operating lease, guaranteed residual value, unguaranteed residual value. There's a lot going on. Okay, so this one, there's a 75,000 guaranteed residual value. All right, so we go back and watch the last video, the fifth one, where we kind of outlined that number and introduce it to the problem. All right, so here's the key thing. Assume the asset is expected to be worth 50 at the end of the lease. All right, so remember, if its expected value is less, we are going to have to record or include the difference, the amount that we're going to have to make up into our problem. If this amount right here was 75 or greater, it'd be the same problem as no residual value that we did back in, I believe, the second video of this chapter. All right, so let's calculate the lease present value. So now we're going to have a future value. It's been zero almost every single time. On the lessee side, it's been zero every time. But now we're going to have to make a payment of 25, so I'll make that negative. Our payment is $48,832. Go back and watch video 5 on leases. That's where we determine that payment. And then this is 5, this is 10, and so we get 219,146. All right, so we've done enough amortization tables now in this chapter and then even in these videos that I just went ahead and filled all this in for you. Okay, so once again, here are my 5. Remember, it's a 5-year lease. There's my 5 interest payments. Okay, but notice now we have this last row of the table. Okay, so that's my residual value. So notice this is the first day of the last year. This is the end of the lease, 12/31/11. So notice we're going to have to make another journal entry there and still record a little bit of interest and reduce our liability down to 0 at the end. Okay, so don't forget about that last row. Another thing I always tell students is if it is up here in this calculation, it's got to be in the table. Okay, so we've got 5 payments, check. We're using interest expense, check, of 10%. We got our 5 payments of $48,832 and our future payment of $25,000. All those numbers have to make it into my table in order to work out. All right, so let's do our journal entries now. So on January 1st, we're entering into the lease. This is going to look just, once we have our table set up, which we do here, then it's just like every other problem we've been doing. We record the asset and the liability at the present value of the lease payments and the guaranteed residual value, which we added in this problem. So that's going to be the 219,146. And then we also make our first payment. So we reduce the liability and record the cash for the 48,832. All right. So same journal entries, except our numbers are different back when we had a finance lease with no residual value at the beginning. All right. 12/31/07. We are going to accrue interest, the first year's interest. All right, so we're going to have interest expense, and we increase the lease liability, and then we'll pay it off on the next day, and that's for the 17,031 from our table. That's a 3 there, sorry, 17,031. And then we also need to record our amortization expense and reduce our right of use asset. All right, and remember, this is back to a finance lease, so we do that straight line. So we take the 219,146, 219,146 divided by 5, and that gives me 43,829. And then the next day, we make our payment. Lease liability cash, 48,832. All right, now once again, if the payment was on 12/30, and I've done this in the prior videos, if the payment was on 12/31/07 instead of 1/1/08, meaning we don't have to do the accrual entry, we would have done interest expense, reduction of the liability in cash. This would be the 17,031 interest expense. This would be 48,832. And then let me scroll up and grab this number from the table, 31,801. So 31,801. So that's if, so like I said in prior videos, a lot of times they'll just make all the payments due on this date, therefore you don't have to do the accrual entry right here. You can just do it all in one journal entry. It still all adds up to be the same thing. It's just a day different. So remember, with accrual journal entries, the whole point is to put this expense in 2007 because that's what it belongs to. That's the period it relates to. All right, so the rest of the tape. So now we've done the first year, and then everything else would look like this, and we would just repeat it over and over again. So let's look at the end of the lease. Okay, so real quick, let me jump back. All right, so the end of the lease once again. So I'm really focused on this row right here. All right, so don't forget about the end of the lease. All right, so this is on 12/31/11. All right, so this is the last day of the lease. Now remember, we don't have to accrue interest here because we're on the last day of the year when we're doing this. All right, so we're just recording interest expense. All right, for 22. I think that was 7/4. Can't read my writing. And then we would have the reduction of the liability, and we would have our cash payment. All right, but remember now my cash payment is 25 because I'm pulling that. So once again, let me jump back here. So remember, my cash payment here is 25. I've got my interest expense of 22.74, and then the reduction of the liability of 22.726. All right, so let me fill that number in. 22.726. Okay, so my liability, remember, is now 0. So that is zeroed out. All right, now remember, up here, we are assuming that it's worth 50. Remember, 50 was what we estimated to be worth, so we had to make up the $25,000 difference. So we don't have to do anything special. Also, don't forget, we also need to do our last amortization expense and reduce our right of use asset. Remember, that's always done at the end of each year. So 43,829, 43,829. Okay, and now this is also 0 because that was our last amortization of the right of use asset. All right, what if it is worth 40? Okay, let me scroll back up a little bit so we can see both here. All right, so I'm just going to draw a line and not rewrite the journal entry. All right, so we'd still do the first entry. So that first entry up there, pulling from the last row of the table, interest expense, lease liability, and cash, we would still have to do that, okay? But now it's only worth 40, okay? So we need to make up a difference of $10,000, all right? Well, how will we do that? We'd have loss on the lease, and we would just have to pay them an additional $10,000. And actually, sorry, we actually do both of those, so first entry and second entry. Sorry, I got ahead of myself a little bit there. All right, so we're still doing both of those entries to record the last. So remember, this takes care of the last row of the table. This takes care of the last bit of amortization. But now we're $10,000 short on this asset we're sending them, so we have to make up the difference in cash. Okay, this part you could combine into the first entry up there. It's just as easy to break it out so it doesn't get so messy with a whole bunch of different accounts in it. Okay, so this is a guaranteed residual value, and this kind of shows you what to do throughout. And then here, this page shows you what to do at the end of the life of the lease. Okay, so once again, guaranteed residual value on the lessee side, how to handle that. So this is important. So when you're reading a problem, especially come test time, if you have a big lease problem on your test, which you probably will, because let's face it, that's all you do in this chapter. You got to read everything, super carefully. You got to make sure you picking out residual values, bargain purchase options, which we haven't talked about yet, and things like that. Picking out, is your professor asking you to do the lessee side or lessor side? I tell my students, one way I do it a lot of times is I will have them determine the payment on the lessor side, okay, and then do the lessee portion of the problem. So you're still kind of doing both, right? But every teacher's a little bit different, so make sure you just pay attention, kind of try to pick up any clues they give you while they're teaching the material, but then just be prepared to really read the question carefully so you can handle whatever's thrown at you. All right, so hopefully this helped a little bit on residual values. Please subscribe to the channel and please share with your friends. Hopefully it will help them as well. And I'll see you next time. We have, I think, one more video left in this one, and we're going to do lessor accounting with the residual value. So we'll hit that next time. All right, everybody have a good day. We'll see you next time.